Yo, welcome back to Infinite Investors, the home for all new and non-investors. I'm Curtis, and today we've got a brand new series, which is the Q&A series. What I'm going to do for you guys is round up all of the questions that you guys ask me about investment, strategy, stock market, finance, or other, whatever question you want to ask, whether it's about a particular stock or whether it's about a strategy or whether it's about what you want to do, whatever you might do, just ask the question. And in this video, I'm going to round up the questions that's been asked. And obviously, I'm going to do my best to answer them as best as possible. What I will say is, obviously, I am not giving you, financial advice. This is just my personal take on the questions that you would ask. If we were friends in a pub having a drink, this is what I'd probably say. And so obviously, you always have to do your own research. But I thought, you guys might like this. Good big shout out to Joshua for giving me the idea for it as well. And yeah, let's see how it goes. So I've got quite a few questions to get through from Instagram. I'm just going to go and check my Twitter now and see if there's actually any questions on Twitter, but I don't think there will be because I didn't actually promote it on Twitter. So I've got a few questions on Instagram. I've got some questions in YouTube comments, and I've got questions underneath this post. So Twitter, it looks clear. So I'm going to go straight to Instagram first, and then we will crack on. So the first question is from Thomas Nuri on Instagram, and he asks, Curtis, how best can I invest for my pension years as I don't have a private one set up? Okay, how best can you invest for your pension years? So if this was me personally, I'm going to give you my my risque approach and my probably what most financial advisors would tell you approach. So my risque approach is that personally, I would prefer to save and invest for my pension myself. I don't mind having a small company pension, but I personally have chosen to not rely on a company or state pension for the future for a number of reasons, which I'm not going to sort of bore you or get into. But it does mean that you have to have a certain level of discipline when it comes to savings. And a certain level of I think discipline is probably the main word, and a little bit of an understanding of finance. And just because I've been fortunate enough to work in banking for many years, that's kind of the reason why I took this approach. So me personally, if I was starting out and I didn't want to put into a pension, then I would probably put it into like a low cost ETF, a passive ETF fund that I know over the long term is going to continue to rise, and then I will just dollar cost average that ETF until I decide to retire. That's probably the way I would approach it. I probably would also try and get a property, just because the value of properties always generally tends to rise as well, and that can be an asset that you can always generate some income from, and you can sell later on down the line. So that's the way I personally would approach it. What most financial advisors would probably tell you is, you kind of answered the question yourself, how best can I invest for my pension years as I don't have a private one set up, is if your company does have a pension that you work for, then obviously be a part of your company pension scheme. I have been part of company pension schemes, as I did mention, so I don't mind contributing a small amount. One of the companies I worked for, if I put 3% of my salary, they put 17%, so it actually worked out to be 20%. So that was a really, really good one, but obviously I don't work for them anymore, and so obviously I don't get that benefit. And then I think the second company I worked for after that, if I put in 3%, they put in 6%, and I think in the last one they didn't even match it, I think, or they did match it, I think, but maybe it was 3 and 3. So it obviously varies from company to company, but if you've got a company that has a pension scheme, put it with them. If not, then potentially look at setting up your own private pension scheme with the likes of Fidelity, Prudential. Just do your research on whichever one you feel is best, Thomas. But thank you very much for that question. The next one or ones is from Aftab Ali, and the first question is, why is it important to diversify your portfolio when you're starting off or with little capital invested? Personally speaking, Aftab, is that if I have a small amount of capital to start with, I'm not focused on diversification. I think the best skill to learn when you've got a small amount, it's my personal take, is how to pick a really good stock. Even Warren Buffett says it. He says that he doesn't really believe in diversification. He believes in picking, 2 or 3 really, really good stocks. And he actually feels that diversification shows that you're actually not that good at picking businesses, because he doesn't believe there's 20, 30 or 40 or 50 good business opportunities. There's usually one, two or three. And so he'd rather just not be in the market and then find that great opportunity and obviously back that fully. So me personally, if I'm starting off with a small amount, let's say I'm starting off with £100, 150, £200, I'd be picking, 2 stocks max, but I'd probably try and pick one stock and just grow from there. The reason why is that I actually really want to become a good investor. So I want to be able to find great stocks. Now, you might not want to become a great investor in terms of being able to actively find stocks. So in that case, then if you cared about diversification, just getting an ETF that tracks an index would probably be the best thing in that scenario. The second question from Aftab was other investing approaches instead of dollar cost averaging that I have considered. So what other investment strategies other than dollar cost averaging have I considered? So I personally have considered a buy and hold strategy, particularly for growth stocks. But I didn't want to do that for this first year just because I felt that the risk of picking a stock, and I didn't really know my stock picking abilities at the time, or capabilities at the time I started. So obviously I came from a day trading world, and then obviously I moved into long-term investing, which is obviously very different things that you look out for. So dollar cost averaging was the only one that I considered if I want to be, specific to the question that you've asked. However, in terms of for the future, I have put some money aside that in 2020 I will back a few different stocks with a lot more money up front and not really dollar cost averaging, just because of some of my videos, as you've seen, particularly the video I said, is long-term investing really worth it? With a lot of my stocks, I would have made a better return just putting the money up front and not dollar cost averaging. But in other stocks, I actually made more dollar cost averaging. So it does actually depend, but I will have some buy and hold strategies. That's probably the other one. The third question from Aftab is, Curtis, your plans when you max out the 20k limit with the Freetrade ISA. When I max out the 20k limit, if I'm fortunate enough to do that, I will just use the basic account. I'll just use the basic account and continue investing in the basic account. That's free. And I should have really invested in the basic account first. I put it into the ISA just because I assumed I would hit the amount early on, not realizing that I've got other stuff that I was actually going to do with some of the money as well. But now this tax year, I do think I'm likely to hit the 20k limit, but I've got 15k left to do till April next year, so we shall see. I have got a few big things I need to do privately. But we shall see. But if I do hit it, then I'll just continue investing in the basic account because it's free, and I'm probably not going to hit the 12k profit that you need to start getting taxed on your earnings anyway, or the 2k dividend. So I will just carry on as normal. And that is all of your questions, Aftab. So thank you very, very much for your questions there. So if we go down, we've got a question from FRGN Land. What do you think the best strategy, growth, value, or dividend investing? Well, as you know, I think I think value is the best strategy. I think it's a blend of growth and dividend. I think growth is amazing. You'll get the most money if you pick the right stock. But again, it all hinges on you picking the right stock. And so I think early on, I think that's a lot more difficult to do. To pick that stock, put a lot of money behind it, and actually get some growth that's actually worthwhile. So I'll say value for me is the best strategy, and then I'll say the second best strategy for me is dividend investing. When I started, I never really thought dividend investing was that much of a big deal, and I've been on a really, really big journey this year where dividends have made up most of my returns, and I've actually realized if you've got a fantastic portfolio of dividend stocks, you are absolutely laughing. And I know a lot of you guys are dividend investors, and I actually commend you. So I would say dividend investing, dividend investing might actually be the best strategy. I might say, but the reason why I say value is that value is a blend of growth and dividend. I think you can get a lot of capital appreciation whilst also getting a good dividend. So an example of that is Barrett. As an example, I'm 20% up on Barrett, and Barrett pays, I think, a 9% dividend a year. So I get a fantastic dividend, and I've got 20% capital gain appreciation. And if I put the money up front rather than dollar cost averaging, I would probably be earning a lot more. Another example is Sentiment. They pay a decent dividend. I think it's about 6%, 5%, and I'm about 22% up on Sentiment. Aviva and Legal & General, they pay a very, very high dividend, but I'm also up on capital gains. So I personally believe that value is the best approach because you get the blend of both worlds. But I do think dividend investing is a great approach as well. Brandon Chong, thank you, Brandon, for your question. Thanks, FRGN Land. Brandon Chong, investing in low-cost index fund rather than trying to beat the market by diversifying. I'll answer your question exactly how you answered it, but I will kind of correct it only because I don't mean to be funny. I don't believe you beat the market by diversifying. I think you beat the market just by trying to find better stocks. I think you diversify in order to actually mitigate risk. That's generally the reason why people diversify. They don't diversify to try and beat the market. They generally diversify so that if something goes down on one side, they make some more money on the other side. But if the question is low cost index fund rather than trying to beat the market, then I think that absolutely depends on the type of investor you are and the type of lifestyle you want to live. If you're like me, who actually wants to be a great stock picker, who actually is passionate about the stock market, who enjoys the stock market, who loves the movements, loves learning about businesses, loves knowing what's going on, then I think trying to beat the market and trying to be a bit more active in your approach is actually going to suit your personality and suit your style a lot more. If you're someone, as I've mentioned in previous videos, that maybe you're passionate about art and design, or maybe you're passionate about football, or maybe you're passionate about something else which takes up gaming or whatever, that takes up all of your time, and you know you should invest, but you don't want to spend all of your time researching stocks, then a low-cost index fund, a passive investment strategy, maybe even having a robo-advisor, so, you know, companies like Betterment and I think Wealthify and a few others, where you can just put money in there and they rebalance your portfolio for you and they try and find the best ETS for you, and it kind of does it all for you, and a lot of them have had decent returns as well. So I think it depends on your personal style. Me personally, I would rather try and be a bit more active, select my own stocks, because I know you can get a bigger return by selecting stocks than ETFs, and I would try and beat the market that way. But I do understand and appreciate that everyone's different, and obviously because of that, then a low-cost index fund can be better suited. So thank you, Brandon, for that question. Mohammed Madi, are you preparing in any way for the apparently imminent recession? Oh, controversial. I don't think it's apparently. I think a recession is cyclical in nature. I think the market is a cyclical vehicle. So if you know anything about how economics works, it generally is, it goes in market-based cycles. So there's obviously, you know, high times and there's low times in every market, whether it's property, whether it's stocks, whether it's milk, whether it's fruit and veg. Everything has a drought, everything has a high season, everything has a low season. That's just the way markets generally work. And what tends to happen, especially in, you know, a lot of these like properties and stocks, etc., because of, without getting into too technical, a bubble can kind of ensue. A lot of debt can be, we can be overspending, and obviously, you know, we can end up getting into a recession. Now, I don't think it's, as I mentioned in the previous video, I do think we've got, on average, I'd say 6 months to 18 months before the recession hits. Also, a recession is technically defined as 2 consecutive quarters of GDP, negative GDP growth. So it doesn't have to be as bad as the 2008 global crisis. So one thing I will just make clear is that people see recessions as like, you know, the Lehman Brothers and people always walking out of offices with boxes in their hands. It's not going to happen like that every single time. Sure, it will be bad for some people more than others, but you know, you might be able to ride it out. So with that in mind, in terms of any preparations, I've made no preparations as of now. But what I will probably do is some stocks I might sell. I will probably do some research on stocks that have, you know, how my previous stocks have handled the other previous recessions, and if I feel like they can return back to good levels, then I'll probably continue just to keep on buying into them while the stocks are falling. So an example of that is the JP Morgan Emerging Markets Fund that I've got. I've already researched that, and they managed the last recession bounce back much higher than before. Whereas other stocks like banking stocks, some of them have not even reached the prices they were before that recession hit. And so, with those ones, I probably would just get rid, to be honest. So I will take it on a case by case basis, Mohammed. I will look at each individual stock. I will look at their history, and then I'll make a specific choice based off their history and based what they've done in the last recession and based off some of the fundamental information on whether I will hold, buy, sell, keep on paying into them, or just save the money up in cash and then wait until the recession's over. And obviously it does depend on how bad that recession is. But thank you very much for that question. Nicholas Mills, what's the difference in cost between buying stocks on Freetrade and Etoro? Interesting question. So Etoro is predominantly CFDs, which is contract for difference. So they're free. There's no cost there. Now, if you want to leverage with eToro, because CFDs are a form of derivative, you can borrow money as part of it to potentially magnify your gains and losses. There is a daily charge. It does vary on the stock that you buy and the volume of leverage. So it can be anything from, say, 30, 40, 50p a day to like £2 a day. So you just got to be mindful of that. And obviously, you can actually go into negative. So you have to be careful on that front. And there's usually a weekend charge. But in terms of actually buying the stock, it's the same. Now, eToro have also introduced actual share dealing, which I believe is charged at 0.9%. So I think irrespective of how much, whatever you buy, the purchase, they charge you 0.9%. But double check on their website. They probably have a pricing link at the bottom, and that will be a little bit clearer for you. The only other questions I've got on some other previous videos is my opinions on Coca-Cola from Alaric Parker. So thank you, Alaric. In terms of Coca-Cola is not a stock that I would invest in personally. I understand it's a very respected dividend stock. I think it's about 3%. But I think it's overvalued from a value standpoint. There's not that much growth in it. It's not something that I will get any joy putting any money into, to be honest. And there's a lot more stocks that pay a higher dividend, great dividend cover, etc., etc. So I understand why dividend investors might like it, but Coca-Cola is definitely not for me. Message from James Winkle. Love the updates. Do you know if Robo Global pays a dividend? Robo Global does not pay a dividend. Robo Global is a growth ETF, so that doesn't pay a dividend. And yeah, sometimes it's a little bit difficult to find that information out, but I generally go to Just ETF. If it's not on Just ETF, then I just try and find the key information document and work it out from that way. And next question from Investing Beginner. What are your thoughts on Freetrade putting back the date until you have to pay for the ISA? Yeah, so I believe that Freetrade, so for those of you who don't know, Freetrade have now extended the date before ISA is being paid for. So from a consumer standpoint, it's fantastic. It means that no one's going to be charged £3 yet, so it's still free, which is great. I think from a investor and business standpoint, I think either A, they haven't figured out how to charge people because they've either got to have some way to charge you from your bank, or you've got to have a balance in the account, or are they going to take it from your stocks, so I think they're probably working that out. Two, I don't think they feel like they've got a strong enough value proposition to charge. Now, you've got to bear in mind the simple fact that Freetrade still only has 300 odd stocks, and so if they're trying to entice people to transfer their ISAs from, say, Hargreaves Lansdown into Freetrade, but Hargreaves Lansdown sitting on 9,000 stock choices or whatever it is, and Freetrade has 300, then to then charge someone for that is, it's not really a great offering. So they're probably going to wait for the investment platform. So yeah, I'm happy from a consumer standpoint, but I think from an investor standpoint, obviously you want to see Freetrade make money, because obviously I've invested in it from a crowdfunding standpoint. But yeah, we'll see. Question from Mickey Deggs. Are you going to try and transfer all of your Freetrade portfolio? I have a smart Barclays investor account. I'm planning my next investments on Freetrade. Just thinking through as new platform come out. Would you leave your stocks fragmented on different platforms? So, question: am I going to leave my money all on Freetrade, or will I invest in different platforms? Like for example, if Evervest comes, simple answer: I will have different platforms. Everything's easy now. It's all on your phone. It's all in the app. Like it's just easy. It's not going to be that difficult to access it. So I have no issues having money on Freetrade, having money on Etoro, having money on Evervest, having money on Robinhood UK. For me, it's about the purpose. What I probably will do is have a specific purpose for each application. So because Evervest have so many stocks, I might make that a dividend portfolio strategy and try to get some of those high paying monthly US dividend stocks on there that are giving sort of 9% returns, etc., etc. I might try use it for that purpose. And yeah, Etoro, obviously I just do speculative trades on Etoro at the moment. So that if I put money in there, it's kind of just to play around with it. And obviously I use that a little bit for crypto, just a little bit. And then Freetrade, I'll probably just keep this running, for the future, because it's obviously in an ISA. And obviously I want to maintain a tax-free status on this money as it grows. So yeah, I'll probably have a different purpose, but yeah, I really, really don't mind having money on different platforms. But thank you very, very much for that question. I think there was one more question that was given to me. So I've got a question from Antonio Riccio. What is going to happen with Acacia Mining Shares? I don't know what's going to happen with Acacia Mining Shares. I can't see the future, Antonio Riccio. But let's have a look at Acacia Mining whilst we're here, and see if I can give you my thoughts on the stock as it is. But yeah, in terms of knowing what's going to happen in the future, unfortunately, I will not be able to give you any form of comprehensive answer. So I shan't try to do that, unfortunately. Graph seems okay, seems a bit undervalued. Oh, the growth, the PEG ratio is crazy. Oh, these ratios are a bit mad. The future performance 15.3, which is okay. No debt, which is good. Or sorry, well covered debt rather. So there's a small amount of debt, but it's fantastic. No dividend. Okay, so Acacia is mining, right? And what do they mine? Is it gold? And sells gold in Africa. Yeah, to be honest, because obviously it's a gold mining, I would say, if the Feds do end up dropping the rate, I probably think that the Acacia shares will rise. If the Feds don't drop the rate, then I think they might fall. They might maintain. By how much, I have absolutely no clue. If it goes into an impending recession, then I definitely think they'll rise. And obviously it depends on how bad that recession is. So yeah, I think if the market is bad, expect a good performance with Acacia. If the market is good, expect either a flat or potentially a negative performance in the future. This is just crazy to me. It's crazy, the figures. But yeah, that's probably the best answer I can give you, Antonio Riccio. But guys, that's all the questions we've got on this week's Q&A. I hope you found this useful. By all means, I will always do another post. If you've got any questions, put them in the bottom of any videos, send them to me on a DM, put them in the comments. I will collate all of those questions and I will make sure that I help you guys with whatever you guys want to know. And I'll try and do it same time next week, Sunday evening. Say Sunday, right? I think so. Anyway, it's all a blur to me now. But yeah, thank you very much for watching. Please like the video, please comment, please subscribe, and I will will catch you next time. I've got a lot of videos coming this week, particularly around investment strategy. So look out for that. Take care, guys. Have a great evening and happy investing.